It absolutely blows my mind when I see people gamble their money on the stock market like it is some kind of slot machine. They are desperately chasing gains while completely ignoring the credit card debt sitting right there, draining them with 22% interest every single month. It is exactly like trying to fill a bucket full of holes and then wondering why you are not making any progress. Too many people seem determined to do everything in the wrong order when it comes to building real wealth. If you want to understand the actual blueprint for investing your money instead of just throwing dollars at whatever sounds trendy, you are in the right place. Here is a statistic that might honestly shock you. According to recent data, 1 in every 3 Americans does not have an emergency fund at all. The median amount that people have saved for a rainy day is a mere $500. $500. That is less than what many people pay for their car every month, and that number has actually dropped from $600 just 1 year ago. At the same time, these same individuals are asking if they should buy individual stocks or jump into the latest cryptocurrency. That is like asking if you should buy a Ferrari when you do not even have enough cash to fix the transmission in your current ride. The truth is that there is an optimal sequence for your money that can save you tens of thousands of dollars and significantly speed up your path to financial freedom. Most people skip this because it is not as exciting as picking a winning stock, but skipping the foundation is a recipe for disaster. Today, we are going to walk through the exact steps you should take to maximize your returns while keeping your risk as low as possible. Some of this will definitely surprise you, especially why your employer match is a top priority, and why certain health accounts are the most powerful tools most people never use. Think about it like building a house. You would never start by picking out expensive light fixtures and marble countertops if the foundation was cracked and the roof was leaking. Yet that is exactly what happens when you buy a trendy exchange-traded fund while carrying high-interest debt that eats your gains alive. The opportunity cost of getting this wrong is staggering. Every month you delay paying off a credit card charging 22% interest is a month where your debt grows faster than almost any investment could ever hope to return. Every month you ignore a matching contribution from your employer is literally leaving free money on the table. And every month you put money into a taxable account before maximizing your tax advantage options is money you are unnecessarily handing over to the government. Before you invest a single dollar anywhere else, you must establish an emergency fund. I know it sounds boring, but this is about more than just bills. An emergency fund creates a psychological safety net that stops you from making panic-fueled decisions when life gets messy. When your car breaks down or a medical bill arrives, having that cash means you do not have to sell your stocks at a loss or go deeper into debt. So how much do you actually need? The standard advice says 3 to 6 months of living expenses, but that is such a huge range it is almost useless. The amount you need depends on your specific life. If your job is very stable with great benefits, 3 months might be enough. If you are a freelancer in a volatile industry, you probably need 6 months or even more. My recommendation for most people is to start by saving your first $1,000 as fast as humanly possible. That covers most minor setbacks and gives you immediate peace of mind. Then move towards saving 1 full month of living expenses. Once you hit that milestone, keep building until you reach the 3-month mark. Research shows that people with at least $2,000 in emergency savings have financial well-being scores 21% higher than those with nothing. That $2,000 provides a massive boost to your mental security and is often the biggest factor in overall financial happiness. Once that buffer is ready, the next step is absolutely crucial. You need to wipe out all high-interest debt, which I define as anything charging you more than about 8% annually. Credit card debt is the ultimate villain here. With interest rates often over 22%, it is financial cancer that grows faster than any reasonable investment return. Carrying this debt while trying to invest is like trying to run a marathon with a heavy backpack full of rocks. Mathematically, paying off debt gives you a guaranteed return equal to that interest rate, which is an incredible deal. If you have $5,000 in credit card debt at 22% and only pay the minimum, you will lose nearly $2,800 in interest over 5 years. That is money that belongs in your pocket, not the bank's. By the way, if you find these financial breakdowns helpful, make sure to subscribe to Billy Finance so you never miss a step on your journey to wealth. There is, however, one big exception to the rule of paying off debt first. If your company offers a retirement match, you should take it immediately, even before finishing your high-interest debt payments. This is a guaranteed 100% return on your money. It is like finding cash on the ground that your employer doubles the moment you pick it up. For example, if you earn $50,000 and contribute $3,000 to get a $1,500 match, that is an immediate 50% gain before your investments even move. No other investment opportunity can guarantee that kind of performance. The key is to contribute just enough to get the full match, then put every other extra dollar back into killing your high-interest debt. This foundation of an emergency fund, debt removal, and employer matching is the bedrock of your financial life, and without these pieces, everything else falls apart. Once you have your financial foundations locked in, we enter what I like to call the tax optimization zone. This is where things get truly fascinating. So many people get this wrong because they are distracted by shiny objects and jump straight into taxable investment accounts way too early. In reality, you should be squeezing every single drop out of your tax-advantaged options before you even think about anything else. Next on the list is maximizing your individual retirement account, or IRA. Now, you might wonder why this comes before putting more money into your workplace 401k. The reason is simple. Your IRA gives you far more control and usually comes with much lower fees. Most corporate 401k plans are notorious for offering a limited selection of expensive mutual funds with management fees that eat into your profits like termites in a wooden house. With an IRA, you can choose low-cost index funds and ETFs that charge next to nothing. Instead of the 1 or 2% fees common in many employer plans, you might pay just a few basis points. That might sound like a small difference, but over several decades, those fees can cost you tens of thousands of dollars. It is the difference between keeping your hard-earned wealth and handing it over to fund managers who drive much nicer cars than you do. For the year 2025, you can contribute up to $7,000 to an IRA, or $8,000 if you are 50 or older. Think of that extra $1,000 as a participation trophy for getting older that actually helps you retire in comfort. Once you have hit the limit on your IRA, then you can go back to your employer plan and contribute beyond the initial match. But this is where the decision gets a bit more complicated, keeping financial advisors busy and everyone else confused. You have to choose between traditional and Roth versions of these accounts. This single choice can literally save or cost you thousands of dollars in taxes over your lifetime. The decision really comes down to one basic question. Do you want to pay the government now or later? Traditional accounts let you deduct your contributions from your current income, but you will pay taxes when you take the money out in retirement. Roth accounts require you to pay taxes today, but every penny you withdraw later is completely tax-free. Here is the general rule of thumb that works for most people. If you are currently in a high tax bracket and expect to be in a lower one when you retire, go with the traditional option to get that tax break right now. If you are in a lower tax bracket today but expect to earn more or see tax rates rise in the future, choose the Roth option to lock in that lower rate. The problem is that predicting future tax laws is about as reliable as predicting the weather 3 months from today. Young people just starting out should probably lean toward Roth accounts because they are likely in their lowest earning years. High earners at the peak of their careers might benefit more from traditional accounts to lower their current tax bill. If you are truly unsure, splitting your contributions between both types is a smart way to diversify your tax strategy. Now, if you have access to a health savings account, or HSA, things get really exciting. The HSA is arguably the most underutilized investment tool in America. It is like the Swiss Army knife of finance, offering 3 different tax benefits that make it incredibly powerful for the right person. First, you get a tax deduction for your contributions. Second, your money grows tax-free while it is invested. And here's the best part. Withdrawals for medical expenses are completely tax-free, even when you are retired. It is the only account that gives you a break on the way in, while the money grows, and on the way out. For 2025, you can put in up to $4,300 for individual coverage or $8,550 for a family. The catch is that you must have a high-deductible health plan to be eligible. If you are young, healthy, and do not have major medical bills, an HSA can be your most effective retirement weapon. Here's a pro strategy. Pay for your current medical costs out of pocket if you can afford it, and let your HSA money stay invested in the market. Keep every single medical receipt because there is no time limit on when you can reimburse yourself. You could pay for a doctor visit today, save the receipt, and pay yourself back from the HSA 20 years from now totally tax-free. After age 65, these accounts become even more flexible. You can withdraw money for any reason, though you will pay income tax on non-medical withdrawals just like a traditional IRA. But since medical costs in retirement are almost a certainty, having a pile of tax-free cash for healthcare is a massive advantage. The math is stunning. If you maximize your HSA for 30 years and earn a 7% return, you could end up with over $400,000 of tax-free money. Considering the average couple will spend over $300,000 on healthcare in retirement, an HSA can make those costs virtually disappear. Once the HSA is full, you go back and finish maximizing your 401k. The limit for 2025 is $23,500 for most people, or $31,000 if you are over 50. At this stage, you are really building momentum. Between your IRA, HSA, and 401k, you could be shielding over $35,000 a year from taxes. That is a serious amount of money compounding without the government taking a cut every single year. Most people never even reach this point. The average person saves only about 6% of their income, which usually is not even enough to get their full employer match. If you can work through this entire sequence, you are already in the top 5% of savers and setting yourself up for a dream retirement. Each step builds on the last, creating a financial fortress that gets stronger every day. Your emergency fund keeps you safe. Your debt strategies stop the bleeding, and your tax-advantaged accounts let your wealth grow undisturbed. But we are not finished yet. Once all those tax-advantaged buckets are full, we finally move to the step most people want to start with: taxable investment accounts. This is the Wild West of investing. You can buy individual stocks, trade options, or stick to index funds without any contribution limits or withdrawal rules. It is also where people make their biggest blunders because they think total freedom makes them smarter. The thing about taxable accounts that is often ignored is the tax drag. Every dividend is taxed, and every time you sell for a profit, the government wants its share. It is like running a race with sand in your shoes. You can still win, but it is much harder than it needs to be. If you invest $10,000 a year for 30 years at a 7% return in a tax-free account, you end up with about $944,000. In a taxable account with the same return after paying taxes along the way, you might only have $700,000. That is nearly $250,000 lost just to tax drag. However, these accounts are valuable for one reason: total flexibility. If you need a house down payment in 5 years or want to retire early before you can touch your retirement accounts, the taxable account is your bridge to freedom. Are you thinking about leaving a legacy for your children, or heirs? Taxable accounts receive a significant advantage known as a step-up in basis when you pass away. This simple rule can potentially eliminate capital gains taxes for your family altogether. There you have the complete roadmap. This is the ideal investment hierarchy that most people overlook in their hurry to find a shortcut to wealth. Begin by securing a solid emergency fund and paying off all high-interest debt. Next, ensure you take full advantage of your employer match, because that is literally free money. Then focus on your IRA and your HSA. Once those are set, aim to maximize your 401k contributions. Only after all those boxes are checked should you turn your attention back to standard taxable accounts. By following this specific order, you will be constructing a solid financial future while others are still guessing which stock will be the next big hit. Your future self will be deeply thankful that you took care of the boring but essential steps first. If you found this guide helpful, please subscribe to Billy Finance for more wealth-building strategies. We would love to hear your thoughts, so make sure to leave a comment below. Thanks for watching, and we will see you in the next video.